Alright, so the stock market is crashing. The S&P 500 is down close to 15% from its highs. Is that really a crash though? Stocks are losing 50, 60, 70% of their value. Yeah, the shitty ones. And this could be only the beginning. But fear not, because in today's video, we are going to take a look at what's going on, how we can take advantage of this situation, and possibly make some money along the way. Ladies and gentlemen, welcome back to Pandrea Finance. I'm Alex Pandrea, and I am here to tell you that it's going to be okay. I know you're looking at your stocks and seeing red all over the place. And if you are new to investing, this all might seem very shocking and concerning. Well, in this video, let's break everything down so you could get a better understanding of what's really going on. Now, a quick note, if you like these types of analysis on the market and what I am investing in, then you can check out my private community Patreon, link down in the description. All money raised there will go back into the community, as I have some really cool plans for it all. Alright, I am excited because it's times like these where a lot of wealth is built. And as long as you don't throw your whole entire life savings into out-of-the-money call options expiring the next day, then you should be fine. Hit the like button. Let's get started. So why is the stock market acting like such a little bitch? Well, there are a few reasons that might be causing all of this. The Federal Reserve's expected interest rate hikes for this year to fight record high inflation rates, along with geopolitical tensions between Russia and the Ukraine. Wait, this just in. Ladies and gentlemen, we have a breaking news alert. We are just getting reports that Russia has indeed entered Ukraine. I repeat, Russia has indeed entered the Ukraine and has begun missile, artillery, and air attacks in multiple regions, including Ukraine's capital, Kiev. Yeah, that can't be good. To understand what's really going on here, we need to go back to the early 90s. Following the Cold War, a treaty of conventional armed forces in Europe was signed between the North Atlantic Treaty Organization, also known as NATO, and the Warsaw Pact, the goal of which was to demilitarize and establish limits on military equipment and personnel in these regions. Basically, they said, hey, let's chill with all these war machines and let's keep our distance from each other. You stay over there, I stay over here, and we'll be good. Over the years, NATO began expanding further and further east, setting up bases in Eastern Europe in countries like Romania and Bulgaria. This, according to Russia, was a breach of the treaty. However, NATO argued that these military bases were not permanent. Hey, are these bases permanent here? Oh, no, we'll just be here, I don't know, 50 years, 100 years maybe, but they're not permanent. Fast forward to today, Ukraine is now in talks to join NATO. And somebody said, okay, enough is enough. It's kind of like your ex-girlfriend who is being hit on by your enemy, and you're like, no, you can't have her, she's mine. Now look, I'm not here to pick sides on who started what. It is a terrible thing to happen to the people of Ukraine who are in the middle of all of this. I just think it's also important that we understand the full history of what's going on. And based off of that, maybe make a little money. So how does this all affect the markets? Well, first off, it's uncertainty, right? And what do the markets hate more than anything? Yeah, uncertainty. So for me, I am hedging my positions to the downside and already have been making some nice profits along the way. I'm also taking a look at stocks in the energy sector, for example, and potentially even short-term plays in the XLE Energy Index to take advantage of rising prices because of this conflict. 40% of Europe's gas imports come from Russia. And now Europe has halted approval of the Nord Stream 2 pipeline, limiting the supply of energy exports from Russia that basically heat up Europe. Well, we could all do some simple math. What happens when there is a shortage of a commodity with increasing demand? You got it. Increasing prices. Good job. Now, I say short term because there is always the possibility that these prices are rising too fast and can't be sustained at these levels. For example, oil just crossed $100 a barrel for the first time since 2014. Now, with that being said, we should also keep in mind that the markets like to price in events and is forward-looking, right? And when it comes to geopolitical risks, the markets tend to overprice them. In other words, they overreact because of the uncertain potential of escalation. So this could provide us with a good buying opportunity if we think that things won't escalate and the markets are oversold. In 2014, when Russia took over Crimea, the market took a 6% hit before the invasion. By the time Russia was in there, the market had already bottomed and started to recover. Now, of course, that was then and this is now, but from my experience, human psychology and how they affect markets doesn't change much. So just be careful with anything with a negative market outlook and be ready to take advantage of the opportunity. AKA, get ready to buy the dip. Possibly. See, all of this comes in pretty much the worst time possible, with already uncertain markets created by inflation hitting record highs and the Federal Reserve's plans on raising interest rates. So what does this all mean? Now, we all know that printing too much money causes inflation, right? So we just have to take a look at how much money was printed. Oh, wait, hold on. Another breaking news alert. 40% of all US dollars was printed in the last 12 months? Yeah, that can't be good. No, I hate to break it to you, but this is not good news for any economy. It certainly wasn't good for Venezuela or Zimbabwe. What about the German mark, its currency back in the early 1920s? I remember reading accounts of money being so worthless, children were just given money to play with as toys. Barrels full of money were being stolen, leaving the money behind and just taking the barrel. Hey, get back here with my barrel. See, when you print more money, you are devaluing the money already in circulation. Imagine if you own a rare Charizard card and then the Pokemon company comes out and says, hey, we're gonna print 10,000 more Charizard cards. Well, you as the owner of that card probably wouldn't be too happy because it will devalue what you already own. Same holds true with the dollar. If you hold dollars and the government prints more dollars, then your dollars won't be worth as much anymore. Now look, I'm not saying that we're anywhere close to the hyperinflations of my previous examples, but this level of inflation still has a major impact on our economy. This is a big reason why I try not to hold a lot of cash and rather invest my extra cash to protect it from losing value. Even under normal circumstances, you are losing about 2% each year to inflation. So for me, I would rather put my money into something that will make me at least 2% to fight the standard inflation rates. And now, well, the word is out. Inflation has hit 7.5%, which is the highest that it has been in 40 years. To fight this, we need to find ways to invest our cash that will make us at the very minimum 7.5% returns. For me, I am making a big bet on cryptocurrency this year. In fact, I recently bought 420.69 for 2069. Ethereum with a little over $1 million of cash that I had, and yeah, I did it mostly for the 42069 meme, but also to combat that cash just sitting there losing value. So how do we fight inflation besides dumping our whole life savings into cryptocurrency and waiting for the collapse of the world economy? Well, all this has led the Federal Reserve, which is the US central bank, to raise interest rates starting in March. Now, what does this mean? Well, higher interest rates means that you are essentially making it more difficult, or rather more expensive, to borrow money, because, well, the interest to be paid on that borrowed money will now be higher. Now, following a domino effect from this, we can expect less people to borrow money, which therefore means that there will be less money in the hands of consumers to spend. Less money means less spending. Less spending will lead to lower inflation. This chart from economicshelp.org really sums it up nicely. You can see how higher interest rates leads to things like reduced investments, reduced consumption, a fall in housing prices, which all will lead to lower inflation, but also, as you can see, will lead to lower economic growth. Because all of this disincentivizes stimulating the economy, we will see this effect. In fact, we're already seeing it affect the stock market. In this type of environment, you would see a sell-off in growth stocks because, as we already mentioned, the market believes growth will slow down. This is also why you see contraction in PE ratios, as the market is less willing to pay high multiples for stocks. So what am I doing? Well, I am taking a look at investments in high yield stocks, companies that will pay me a high dividend in this slower growth environment. So even though the stock's appreciation could slow down, at least I am making a return to compensate for that. I'm also looking at stocks in the financial sector who historically have done well alongside rising interest rates, and adding those stocks to my portfolio. Again, if you want to see what I buy and sell in my personal portfolio, you can come join me on Patreon with the link down in the description. Okay, let's talk about shorting the market. The market is going lower and lower each day, and some of you out there want to pretend to be Michael Burry from The Big Short, becoming rich by shorting the market.
Can we make it 100 million?
You know who you are. So there is a difference between shorting the market and hedging your position. When you short the market, you are net short, meaning you are hoping that the market crashes and the majority of your investments make money if the market goes down. This differs from hedging because when you are hedging your portfolio or investments, you are buying insurance policies that would pay off if the market goes down, and the money that you will lose on your portfolio and long stock positions will be balanced out by the money that you make on your hedge. So you have your portfolio and whoops, the market is going down. You now hedge your positions to the downside. Your portfolio is losing money, but your hedge is making money. So ultimately, this should save you money. So the first thing that you have to decide is if you think this is it, the world is ending, then you can short the market. If you think that we will recover from this like we recovered from every single market crash, then you might be leaning more on the hedging side, like I am. So here are ways to short the market, or better yet, hedge your positions. Buying puts on the S&P 500. SPY is the ETF that tracks the S&P 500 index. I put on short positions for the purpose of hedging my overall portfolio and have more than tripled my money on those trades. The S&P 500 Bear 3X Leveraged ETF, ticker symbol SPXS. You can go ahead and buy shares or call options on an ETF that inversely tracks the S&P 500 with a 3x leverage, which means that if the S&P falls 2%, then this index will rise 6%. However, this also applies on the downside as well, right, with losses. So be careful whenever you use these leveraged ETFs. Covered calls. You can sell covered calls on your stock. Since everything is going down, you are losing money on your long stock position. But you can make some of that money back by selling covered calls and collecting a premium along the way as it goes down. Keep in mind that you should always sell covered calls with a strike price above your cost basis from what you bought the stock for. In case your shares get called away from you, then you won't actually lose any money. Now, I did a whole video on covered calls, so just click right there. Call credit spread, also known as bear credit spread. Now, if you have followed my iron condor videos, you'll notice that a call credit spread is the top half of an iron condor. You sell a call and then you buy a call at a higher strike price. This essentially allows you to sell calls and collect the premium without having to have 100 shares of the company that you usually would need to in order to sell calls. You'll make less profit, but you'll also have less risk. Buy volatility. You can also short the market in essence, or hedging your positions by buying shares or call options in the VIX Volatility Index. Ticker symbol is VXX. This index has an inverse correlation to the S&P 500 index, so going long the VIX means you are short the market. So those are some of the ways that I like to short, or rather hedge, my positions. Now, the most important thing to keep in mind is that you always want to continue to buy into the market at lower and attractive prices. This is what I am doing. I'm using the money that I make off of my hedge positions and taking that profit and buying the companies that I want to own for the long run at these new low prices. Think to yourself, which companies are you happy when they go down? Which companies will you not hesitate to buy and say to yourself, if I only had more cash, I would buy this company? Asking yourself these questions will make you understand your investments better and realize what you should and shouldn't be investing into your portfolio. If you hesitate to buy into a company after it's fallen already 50%, then you probably don't really believe in the potential deep down inside. I know for me, this has really helped me in my investing. Remember, times like these are some of the best opportunities to grow wealth. So stay as informed as possible, keep your mind open to learning as much as possible, and most importantly, subscribe to this channel so we can go on that journey together. Make sure to check out the links down in the description, check out my other videos here and here, I like this one a lot, and comment down below what you are investing in this crazy market. Pandrea, out.